Good morning, everyone, and good evening to those joining us from the US. Welcome to the QuickFee FY23 Financial Results webinar. On our call today, we have Simon Yandel, CFO, and Jennifer Warrifer, President of North America, to run through the presentation. And my name is Katie McKenzie, Investor Relations for QuickFee. The presentation will run for about 30 minutes, and then we'll open up for Q&A. We won't be using the hand-raising function, so if you have any questions, please type them into the Q&A tab at the top of the screen. If we don't have time to get through all questions today, then we'll reach out to you directly following the webinar. And now I'd like to hand over to Simon Yandel.
Thank you, Katie, and welcome everyone to QuickFee's FY23 results presentation. The business has delivered a very pleasing set of results this year, with 37% revenue growth over FY22, underpinned by record transaction volumes. In particular, total transaction volumes, or TTV, for our main fee funding product, which we refer to as finance or pay over time, in Australia was up 22% to 46.4 million Australian dollars, and in the US up 24% to 20.9 million US dollars. And we saw improved revenue yields and margins in both markets for this product. Our US Pay Now TTV was up 21% to 1.2 billion US dollars, and we saw record firm numbers in both markets. We also reported a decrease in operating expenses of 21% versus FY22, and an EBITDA improvement of 48%, and we'll go through the detailed numbers shortly. So in summary, our narrower focus in the US on accounting and legal markets has delivered the revenue growth and cost reductions that we had flagged. We have streamlined the business and our strategy, and we've renewed our leadership talent. This has positioned us very well to continue our fast growth towards profitability, all within our very low credit risk business model. Jennifer will now touch briefly on some of the strategic successes we've seen in the last year.
Thank you, Simon. So in a moment, Simon's going to walk you through the details of our financial results for FY23. But before he does, I wanted to call out the significant amount of progress that's been made in the business over the last year. We continue to innovate and enhance our technology solutions and payment platform, which delivers a more automated bill-to-cash cycle, thereby reducing time on lower value tasks and driving efficiency within the firms that we do business with. Our Connect product allows firms to integrate with their practice management solution and power e-invoicing and faster payment by their clients. And in this fiscal year, we delivered 2 additional integrations, CCH Access and Iris Practice Engine. We refocused the business back on the verticals that we excel in professional services, specifically accounting and legal. We strengthened our team with key hires, not just in leadership roles, but throughout every single area and every level of the business. We eliminated distractions, and a key example of that is the discontinuation of our BNPL product. The key message that I want you to take away is that while we delivered strong results for FY23, we did so while we were transforming every area of the business. We were building the plane while we were flying it, so to say, and thankfully did so successfully. That said, the plane is now built, the foundation is laid, and the major changes are behind us. We are truly at an inflection point in our business. All of the hard work our team has already started to deliver the results, as Simon will walk you through in a moment, but we're just getting started. With that, I'll hand it back over to Simon.
Thanks, Jennifer. I'll run through the financial highlights and then we can discuss each product in a bit more detail. All the financial figures here are in Aussie dollars. We show our revenue in 2 main product streams, revenue from our finance or pay over time product and revenue from our payments or pay now product. Revenue from the finance product globally was up 47% to $7.8 million, and revenue from payments was up 27% to $7 million. Bringing total revenue for the year to 14.8 million, up 37%, as we've mentioned. Gross profit was up 24% to $9.4 million. Operating expenses, as mentioned, were down 21%, which led to adjusted EBITDA being up 48% to negative $6.6 million. We call it adjusted EBITDA because it's statutory EBITDA less the interest expense on our loan borrowings. After that, net profit after tax showed a 40% improvement to an $8.1 million loss. Our operating cash flow improved by $6.8 million. Our loan book balances grew 31% to a total of $43.2 million. And we once again incurred minimal bad debts at 0.1% of lending. You'll see on the bottom right our cash and liquidity at 30 June 2023. With cash availability of 8.2 million at 30 June, we have sufficient headroom to execute on our growth strategy and achieve sustained profitability into the future. What I thought I'd do now is have a little bit of a look at our pay over time product. This is our finance product, and it's shown encouraging growth in FY23. And with us now leading our sales activity with this product in both markets, it's important to understand the levers that drive this revenue. Importantly, revenue has grown faster than volume in both markets. And interest revenue from lending will naturally increase as we write more loans just based on higher volume. However, in response to interest rates rising in both markets, we've increased our interest rates that we charge clients of our firms for their payment plans. And we did it in October 22 and again on 1 July this year. We're able to do this without impacting demand due to the ease with which clients can take out a payment plan. They have no credit checks or approvals, and the fact that the product is free to the firms, and the firms get paid in full immediately, means that firms love it too. The chart on the top right of this slide shows Australia lending volume for FY22 and 23, then the revenue yield percent we make from that volume, and revenue yield is simply revenue divided by that volume. And then the bar on the far right shows how our FY23 revenues are made up, starting with FY22. And then on top of that, you can see $0.8 million of revenue growth is from higher volume of lending. And then another $0.8 million is from the increase in rates we charged over and above prior year revenue. And similarly, in the US chart bottom right, $0.3 million has come from each of volume growth and yield growth over the prior year revenue. Because interest revenue is recognized over the life of these loans, typically with an average life around 9 to 10 months, there's a long tail of revenue to be recognized at those higher yields into FY24 from loans that we've already made. So there are two components to revenue growth in our finance product. Clearly one from the volume we write, but also from the higher prices we can charge clients. Looking at our pay now payments business, most of this, about 80% of the revenue comes from the US and 20% from Australia. We make a small margin on the Australian pay now business. Most of online payments are free in Australia, so it's not a huge margin. But out of the 80% in the US, 90% of that comes from ACH and 10% from card, ACH being the US equivalent of EFT online payments. And while yields on these products remain relatively stable, we have a track record of strong volume growth, both from new firms we're signing up and the structural tailwinds that are driving increased adoption of online payments from our existing firms. And we expect growth from both of those to continue. I'll hand back to Jennifer to give a brief overview of our current product suite and how we're positioning ourselves today.
Thank you, Simon. So founded in Australia, QuickFee has been in business since 2009 and entered the US market in 2016. Since its inception, QuickFee has had one mission: to help professional service firms get paid faster. QuickFee's payment platform allows a firm's clients to pay now through ACH or EFT or credit or debit card, and also offers a lending option that's proprietary to QuickFee, QuickFee Finance. This pay over time option allows clients to pay over 3, 6, 9, or 12 months while the firm gets paid in full upfront at no cost to the firm. For those of you who haven't seen the simplicity of our offering, we thought we'd share the payment flow for one of our customers, Lolly & Company, which is a Pittsburgh, Pennsylvania accounting firm. What you see on this screen is the payment landing page on Lolly's website. Regardless of which of the three options their client selects, it will take them directly to the QuickFee payment portal. Once they get to the QuickFee payment portal, they will see this screen. The firm's client simply selects their payment preference, and it shows them the payment amount or amounts in the case of QuickFee Finance, including any surcharges or interest costs. We are very clear on who our target customers are: professional service firms that are primarily solving business clients. If you drill down further, the primary verticals we serve are accounting and legal professions with over $1 million in revenue. Additionally, we also do business with professional service firms and other verticals such as architects, engineers, and management consultants, but 100% of our outbound sales and marketing activities and efforts are in our primary verticals. Like all companies, we have competitors in the market. However, we have a few key differentiators that set us apart and give us an advantage. First, our proprietary pay over time QuickFee Finance product. There is no other company that we run up against in the market that offers a comparable like-for-like solution. QuickFee Finance allows the firm to get paid in full upfront, improving their cash flow, while allowing their clients to pay over time without any credit checks or lengthy application process, also improving their cash flow. It's a win-win for the firm and their clients. Second, our product passes the credit surcharge on to the firm's clients. In some cases, this has saved firms tens of thousands of dollars a month in credit card surcharges alone. Third, we offer integrations with market-leading practice management solutions, including CCH ProSystem Effects, CCH Access, and Iris Practice Engine. These integrations help automate the bill-to-cash workflow, freeing up time in the firm that was previously spent on lower value activities. And finally, although there's no doubt that automation has dramatically improved workflow inside a firm, we also recognize that sometimes support is needed beyond just technology. In other words, it needs a human touch. Our world-class US-based customer support team is available by email or phone to ensure that we support firms in whatever way they prefer. And our customer success team will even help make a firm make accounts receivable calls to ensure they get paid as quickly as possible. Now, I'd like to take a few minutes to talk you through the growth opportunity in the US market. And we're going to start by taking a look at the US profit and loss for FY23. In FY23, we achieved strong revenue growth, with revenue increasing by 36%, driven by 24% growth in US lending to $20.9 million at an 8.8 average revenue yield, up 150 basis points, and 21% growth in Pay Now total transaction volume, or TTV, to $1.2 billion. While growing on the revenue side, we also achieved improved profitability with significant improvement in adjusted EBITDA to negative $0.7 million, indicating the US business is tracking towards operating profitability. On the new customer acquisition front, we had strong growth in firm numbers, up 8% to 756, as well as customer numbers up 26% to 319,000, indicating greater penetration of the QuickFee solution in each firm. The focus on margin improvement is noticeable, as a higher portion of our customers are utilizing the higher margin finance product. We had 120 firms sign up in FY23, of which 49 signed up to finance. Finally, our refreshed US sales strategy is in place, which we expect to drive positive outcomes in FY24. That refreshed strategy includes implementation of a new territory-based sales model and updated remuneration structure to drive new firm acquisition, connect signups, and finance TTV growth. There are two primary ways we think of the significant opportunity that sits in front of us in the US market, which are increasing transaction volume from our existing customers, as well as bringing on new customers. As it relates to our existing customers, their combined annual revenue is around $10 billion. Right now, only $1.2 billion of that annual revenue is processed through QuickFee. The remaining $8.8 billion is primarily being received by check. As digital payment adoption in the US accelerates, our total transaction volume organically increases. In other words, as the US market continues to mature in its digital transformation journey, there's over $8 billion in annual revenue we could capture from our existing customers alone. To help us do that, we have QuickFee Connect. As you've heard previously, Connect provides integration into leading practice management solutions, helping turn a manual, often paper-based invoicing process into an automated digital process by sending out the invoices generated within the practice management solution via email. Those invoices have a payment link on them, which sends the customer directly to the QuickFee payment page. As of the end of FY23, we have 3 integrations and a number of others already in the queue, which I'll speak to in just a few minutes. As it relates to the US market in general, the firms that are in our target market with over $1 million in annual revenue represent about $38 billion in total revenue. of which QuickFee's customers represent about 10 billion. That means we have about 28 million in annual revenue sitting in accounting firms that don't currently work with QuickFee. Our sales team is laser focused on bringing those firms to QuickFee. It's also important to know that this slide is just calling out the opportunity sitting in one of our two primary verticals, accounting. We have just as much, if not more, opportunity in legal. As you'll see on this slide, the US and Australian markets are at very different places as it relates to adoption of e-invoicing. In Australia, 86% of firms say that over 75% of their invoices are being sent electronically, while in the US, that number is only 32%. The market is way further behind in the US in this regard, and as the market moves forward, the organic growth opportunity in our business is tremendous. As I shared earlier, our integrations with leading practice management solutions through Connect gives us an advantage in the market while helping us automate the bill-to-cash workflow within firms. Today, we have integrations with CCH Pro System Effects, CCH Access, and Iris Practice Engine. But as you can see here, we have many more integrations in progress and being planned. To wrap up the US section, I'm excited to share with you some of our near-term strategic priorities. First, we have a significant focus on driving organic growth through sales and marketing activities. As of August 1st, our sales team moved to a territory-based model, with each territory having an account executive focused on new customer acquisition and a relationship manager focused on increasing total transaction volume for their territory, with QuickFee Finance and Connect being their highest priorities. This territory model is supported by a new commission plan, which rewards for the results that have the highest impact. Second, we have amplified our focus on strategic partnerships and alliances. Although our historical model of acquiring firms one at a time has been successful in delivering strong growth, we know that to achieve our aggressive targets and ambition, we need to partner with companies that will allow us to drive exponential growth through one-to-many partnerships. Finally, our product and development teams have a narrow focus on developing solutions that will have the greatest positive customer impact and unlock our ability to capture as much transaction volume as possible. This includes our Connect product and related practice management integrations, as well as a completely refreshed user interface, or UI, and user experience, UX. While we're accelerating our product roadmap, we're also being highly intentional about ensuring we're doing it in the most cost-effective way. And I'll hand it back to Simon to speak to the Australian business.
Thanks, Jennifer. As you can see, the US represents, an enormous opportunity for us, and QuickFee really is a US growth story. But having said that, the Australian business is performing really well right now amidst an increasingly deteriorating economy. As a mature market, with 2 or 3 established players, growth in lending in Australia is driven more by external demand factors rather than substantial market share shift. But one area we are seeing higher volume growth is in our legal disbursement funding business, which we've been offering since 2014. But this product provides funding for disbursement costs for personal injury law firms, and these loans can run for up to 30 months. The QuickFee business in Australia is profitable in FY23, and we expect its contribution to the group to increase as we continue to serve quality accounting and law firms. QuickFee founder and executive director Bruce Coombs continues to lead the Australian business, and we have a committed and stable team servicing our long-term customers in our home market. So the financial performance for Australia, we've seen increasingly challenging economic conditions. That's driven robust lending for fee funding solutions across our client base. The key takeaways from the performance of the Australian business are strong revenue growth, revenue up 36% to 6.1 million, a 37% increase in finance revenue to 5.2 million, and a 22% growth in lending to 46.4 million. Our finance revenue yields have increased 130 basis points to 11.3%. And the business posted a positive EBITDA of 0.2 million Australian dollars. So new customer acquisition has predominantly been in the legal disbursement funding space. As I mentioned, it has shown substantial growth and now accounts for about 15% of our loan book in Australia. Customer penetration within firms has improved, with firm numbers up 6% to 525, and customer numbers up 11%, almost double that growth rate, up to 39%. So you can see more customers, customer growth is faster than merchant growth. So the outlook for lending demand in Australia is promising, and we expect to see economic conditions continue to be challenging. Consumers and small businesses face hundreds of billions of dollars of fixed rate home loans converting to variable rates, as we all know. And that'll happen over the remainder of 2023 and 2024, and we expect that to drive further borrowing demand. So the prospects for Australia are looking promising. And I'll go through the detailed financials for the group as a whole. We've talked about strong revenue growth, which reflects our focus on the higher margin financing product in FY23. This was partially offset by higher interest expense, which was up $2.6 million, which was driven by two factors. Firstly, higher interest rates on borrowings, which are linked to both the US and Australian cash rates, and they both increased substantially over the course of the year. And secondly, we had surplus cash on hand in FY22, and because of that, the level of borrowings last year were lower than one would normally expect to fully fund our loan book. So the FY23 figure is more representative of ongoing interest costs. That meant the gross profit, while up 24% to $9.4 million, grew at a lower rate than revenue. However, with a 21% reduction in operating expenses, adjusted EBITDA improved by $6 million. With the increased focus on reaching profitability and the removal of non-essential costs from the business, all our operating expense categories decreased in total by $4.2 million, with H2 for the FY23 year lower than H1. In fact, total operating expenses in the last 4 half years have all decreased consecutively. So we've been pretty prudent in removing non-essential costs from the business. General and admin costs decreased by 5% to $7.1 million. Sales and marketing costs decreased by 11% to $2.4 million, as our target markets narrowed to accounting and law in the US. Customer acquisition costs, which include overheads from sales management, new business, sales staff, direct marketing, and merchant onboarding, were reduced by 45% to $2.6 million. And product development reduced by $1.3 million, or 25% to $3.9 million, reflecting the step down in technology spend that started in April 22, and the subsequent focus on cost-effective investment on really Connect integrations. And the Connect integrations, as Jennifer mentioned, accelerate volume and revenue growth. We're also focusing a little bit on product UI and UX, and that'll drive sign-ups and retention. So we continue to be prudent with our dollars and spending only where we'll get the most revenue benefit in our existing markets. And consistent with our focus on cost containment, our headcount globally reduced by 6 to 45 at 30 June 2023, and that comprises 28 in the US and 17 in Australia. Important to just underline, one of the core principles of our business model is the low credit risk nature of our lending products, which are reinforced by our professional firms guaranteeing their clients' borrowings. So net bad debt write-offs in FY23 was $78,000, 0.1% of total lending. And our 60 average is 0.18% of lending. So a very good example of the low credit risk nature of all our lending products, and most importantly, the firms we underwrite. And we expect bad debt levels to stay at that very low level. Quick look at our balance sheet. QuickFee's lending business relies on its asset-backed borrowing facility with Northleaf Capital to fund approximately 90% of growth in the loan book, with 10% funded out of our own capital. The strong growth in lending in the year has led to our loan book growing $10.3 million to $43.2 million at 30 June 23. That's up from $32.9 million at 30 June 22. And the growth across both the US and Australian books has been primarily funded by drawing on the Northleaf facility. The group remains well funded with adequate liquidity and growth capacity. Net assets have decreased in line with the loss for the period, and we keep cash balances at a minimum. I'll explain a little bit more about that on the next slide on liquidity. We have total liquidity of $8.2 million, and that is a measure that sums up the cash that is available to draw on our facilities based on the loan book plus the actual cash held. So we have cash available of $8.2 million at 30 June. Our debt facility with Northleaf is currently 54% drawn, giving us that total liquidity plus further growth capacity within that facility of a total of $27.9 million. As I said, we don't draw any more cash than we need to, so we minimize the actual cash on hand, and that minimizes our interest expense. And based on this, we're very comfortable that we have sufficient liquidity headroom to execute on our growth plans and reach sustainable profitability. Very quickly on our cash flow statement, on the left-hand side is a summary statutory cash flow, and on the right is the reconciliation from loss for the year to operating cash flow. Our operating cash flow for the year was negative $16.2 million. It's an improvement of 6.8 on the prior year, and operating cash flow is comprised of two main elements. The first is a cash outflow from operating activities, negative 6.9 million, and that represents the cash burn from running the business, and that will become positive once we're profitable. The second line, net cash outflow from loan book / merchant funding, represents cash outflow from funding our loan book growth. Loan book growth is funded from a mixture of debt facilities at 90% advance and 10% from our own funds. So as our loan book continues to grow, that second line will continue to be negative as we lend more money, and that's actually a good thing. So our operating cash flow will continue to be negative because of that borrowing line there. That obviously comes down in the bottom half of the cash flow statement with our proceeds from borrowing facilities. There are more financial and operational details in the appendix to this deck if anyone wants to look at them later, but I'll hand back to Jennifer now to wrap up and take questions.
Thank you, Simon. So as we wrap up today, I want to close with a recap of our highest level strategic priorities for the business in FY24, as well as our outlook for the year ahead. Our number one responsibility and assurance to our shareholders is reaching profitability, which is mission critical. We will continue to manage our cash burn and be exceptionally diligent in managing our expenses. As I shared earlier, the opportunity in front of us is tremendous, and we're just getting started. Leveraging strategic partnerships to drive exponential versus transactional growth is a key part of our strategy. And finally, I want to assure you that continued enhancement to our systems redundancy and business continuity processes is always high on our list. After spending time with us today walking through our FY23 results and FY24 strategic direction, I hope that you felt the excitement and the momentum that continues to build in both our Australian and US businesses. We have the right people in the right seats to execute on our plan, and we're confident in our ability to deliver strong growth, and we're tracking towards operating profitability within our existing cash and borrowing facilities. I want to thank you so much for joining us today. We know your time is valuable, and we appreciate you spending part of your day with us. Additionally, we appreciate your continued support and investment in the QuickFee business. And now I'll hand it back over to Katie to facilitate Q&A and any questions that may have come in during the presentation.
Thanks, Jennifer and Simon, for the presentation. We have a few questions here, one for Simon. So Simon, you mentioned that QuickFee benefits from favourable economic tailwinds in a rising interest rate environment. Can you be a bit more specific about the key factors driving demand for your solution in more challenging economic conditions?
Yeah, it's a great question, Katie. I think the demand for borrowing, clearly as cash dries up in the economy, we saw during COVID a lot of surplus cash through government stimulus. That is all gone now. There's cash in households as mortgages are costing more every month with interest rates going up. Inflation is putting huge pressure on cost of living. So consumers and small businesses have less money. So the demand for them to take out payment plans for their accounting and legal services increases. Likewise, accounting firms themselves have an increased demand to actually accelerate their receivables and boost their cash flow. So you get both sides of our QuickFee sort of payment plans benefiting from more volume. From a high interest rate point of view, we're able to increase interest rates pretty much at will. We don't do it every time the Reserve Bank raises rates, but we try and keep it to maybe a couple of times a year in the last 12 months. But they have been reasonably significant increases. And what that's meant is we're able to maintain our net interest margin between what we receive from clients paying loans and what we're actually paying our lender, Northleaf Capital. So we've managed to maintain that interest margin at probably around about the 11 to 12% across the year, and that should continue into the future.
Okay, great. Thank you, Simon, for that answer. We also have a question here for Jennifer. Jennifer, can you just talk a little bit more about the competitive landscape and sort of the length of the sales cycle?
Yeah, thank you, Katie. I think it's a thoughtful question. We touched on some of the competitive landscape in the presentation, but I think there's some things that make us different than the competitors that are out there. Obviously, we have some newer competitors to the markets. They don't have the longevity that we have in the US market. We have a unique solution with our finance product. Of course, our Connect integration, but something we didn't step into too much in the presentation was around that human touch. And what we're finding is there are many others in the market that they've gone to all automated support, or they don't have a US-based support team, and that's really important to our customers when they need help or they have a question. They want to be able to talk to someone. So that's been something that's helped us stand out. Our continued innovation and investment in our product makes sure that we're delivering the best technology to our customers, and we're continuing to get positive feedback on that. But I think service is definitely a huge differentiator for us alongside the technology itself. As it relates to the length of the sales cycle, this is a moving target, if you will. I mean, the target, I guess, is ASAP, or as quickly as possible. But we've had sales processes where we've had a lead come in or an outbound call from one of our sales reps, and they've seen that close within 24 hours. Like, it's the first call and it closes. And then we have some really large firms that have taken over 12 months. So the sales cycle really varies, but typically you would see on average between 30 to 45 days for the average sales cycle. I do like it when they happen faster than that, though.
Okay, thank you, Jennifer. We don't have any further questions at my end, so I think we can wrap up the call. Thank you, everybody, for joining us today to learn a little bit more about QuickFee. And if you've got any questions, you've got the contact details for Simon and myself there on the page. Thanks, everybody.
Thank you.
Thank you.